tax-free point. So step number one is always fund an emergency fund first. And this goes back to Dave Ramsey as well. He always talks about having 3 to 6 months living expenses liquid at all times, right? So this is your emergency reserve if medical expense or something else comes up. Funding and maintaining this reserve should always be your first priority. And don't advance to any of the other steps until you've really completed step number one. So the second concept that we really want to introduce you to is that Social Security can become taxable income, right? And this is one of those misconceptions that we seem to have with people all the time, that they feel that Social Security is it's tax-free. And the reality is that it isn't tax-free, and it becoming taxable it becomes taxable much faster than most people anticipate. So to give you an idea, in 2021, 50% of your benefits become taxable if your income is 25 to 34,000 for an individual, or 32 to 44 if you're married filing jointly. And 85% of your benefits are taxable if you make more than 34,000 as an individual, or 44,000 if you're married filing jointly. So if you made $35,000 between you and your spouse in 2021, 50% of your Social Security would be taxable. If you made 44,000 or more in 2021, 85% of your Social Security benefits are taxable. And this really is an area that has a big hit on people's retirement, is because they're thinking, hey, I've got this Social Security, it's tax-free income that I can count on during retirement, not realizing that there's kind of a pitfall here of, if you're taking money out of your IRAs, that's taxable income. If you take enough out of the IRAs, now you're going to be paying tax on your Social Security as well. And so it's really a concept that we want to make sure that our clients understand. The next one is, we would like to talk about the standard deduction, right? Because this is going to come up when we get into the implementation and the plan itself, is understanding what a standard deduction is. Without really getting too complex in the tax discussion right now, a standard deduction is just the standard amount that a non-itemizer can subtract from their income before income tax is applied. So in 2021, it was around $12,500 for single taxpayers, and for married couples filing jointly, $25,100. So part of our plan when we meet with our clients is we talk about planning your RMDs, right? And what an RMD is, for those that don't know, is a required minimum distribution, which is the amount that the IRS requires you to distribute from a tax-deferred account starting at age 70 and a half. So essentially what happens is, if you fill up bucket number 2 that we talked about earlier, this is your company 401k or IRAs, during retirement, the IRS is going to start to force you to take money out of these accounts each year. They're going to make you take a percentage of your overall balance out of these accounts, whether you need the money or not, right? And for our clients, our concern is that you don't want to have money forced out of these accounts to pay tax on until you actually need those funds to use. So our plan is, we want to plan our RMDs to be low, and to try to make our RMDs meet our standard deduction, right? And there's a reason for that. If the standard deduction for a married couple is $25,000 during retirement, and obviously it's hard to project this out, the farther you are from the retirement, it's going to be harder to project where tax rates will be or where your standard deduction will be. But generally speaking, let's say the standard deduction is $25,000, and your RMD is $25,000, which means you're being forced to take $25,000 out of your 401k or your IRA during retirement. Now Social Security won't be taxable, right? Because if you get $25,000 of income before income tax kicks in, and your standard deduction is 25, and you take 25 out of the IRAs, the standard deduction is covering the RMDs that you're taking out. So in terms of bucket number 3, if we scheduled and we've planned around having our RMDs equal to our standard deduction, when we get to bucket number 3, this is really the area that maximizes the potential for having income that is tax-free, right? So bucket number 3 is your Roth IRAs, your life insurance, municipal bonds. So if Social Security, the combination of Social Security and your IRA RMDs equal to your standard deduction, don't provide enough income in retirement to cover your expenses, you pull the surplus that you need from bucket number 3. So we're going to go into a case study in a moment. We'll kind of go through the numbers, but the thing to keep in mind here is that bucket number 3 is really the most critical. As the need for retirement income gets larger and larger, so too will bucket number 3 will need to grow proportionate for you to have an available base to pull from that's tax-free. And step 4 is to use trust for estate planning. And that's something that can be prepared by an attorney. Contact our team. We can help walk you through the process of using those vehicles. But, we're not going to go too in depth into this discussion today. So a summary of kind of the outline of the plan, and don't worry, we're going to get a little bit more into this in a minute, but the plan that we just presented is completely tax-free. Because your RMDs were equal to or below your standard deduction, you didn't have tax liability on the money that you were taking out of your IRAs or your 401k. Therefore, Social Security didn't become taxable. And then you funded the difference from bucket number 3, that tax-free bucket. So in that scenario, your tax liability is, somewhere near zero, and you were able to pull a pretty decent amount of income out without having to have any tax implications, right? Getting to this point in retirement is a very difficult thing to do. It requires a lot of serious planning and preparation. It involves allocating your resources or the money that you save amongst the different buckets that you're going to need during retirement, so that you're prepared to make this work. So the next portion I'm going to talk, first I'm going to give a case study, kind of give you an idea, and we're going to use this case study to kind of spark some understanding of exactly what this would look like for a normal client of ours. So in this case study, we have the Prescott family. They need $90,000 a year after tax during retirement to be able to maintain their lifestyle. And their goal is that they want to pay zero tax during retirement if it's possible. So the fixed number, they have $25,000 per year that comes in from Social Security. They've funded their bucket number 2 appropriately so that the money that they're pulling from bucket number 2, which is about $20,000 a year, is at or below their standard deduction, which is great because now we don't have to worry about any tax implications from number 2 resulting in Social Security becoming taxable. And then last, to get to the $90,000, they pull $45,500 per year from bucket number 3, right? And because the bucket number 3 is is not taxable income, this is how they get to that $90,000 a year. So they're taking $90,000 out of each bucket to cover their living expense without any tax implication, right? So for us, this is that model zero tax retirement. And they're covering any emergency expenses or maybe realizing some gains in low tax years out of bucket number 1. And so for this client, for the Prescott family, they can make $90,000 a year as an after-tax number and comfortably fund it during retirement without needing to worry about paying tax. But for most of the clients, before we get started, this is kind of the plan that they're on, is a non-tax efficient retirement. So in this scenario, this is the unoptimized version of the Prescott family. They have $25,000 a year of Social Security. They need to pull $65,000 per year from the tax deferred bucket. And we just did kind of some rough tax calculations. So they pulled $65,000 a year from their IRAs, from their 401k. They had a standard deduction of $25,100. That means they had $39,900, around $40,000 in taxable income. And so the tax rates on that, 10% for the first 19.9, 12% on the next 20. Then because of the amount of money that they made, Social Security became taxable. So they'd have $25,000 of Social Security. 85% of that would be taxable, which brings us to $21,250 of taxable Social Security. Taxed at 12%, that's $2,550. Just their Social Security is taxed at has a tax bill of $2,550. The money that they pulled from bucket number 2 has about $4,400 of tax. So their total tax bill is $6,940. But for most people, they get this 6,000, for the Prescott family, they get $6,940 tax bill. They have to pull from bucket number 2 to pay their taxes. So they pull 6,940, which results in another tax liability of $833. So that takes their net tax bill for this current year that we're looking at to almost $7,800. And so if you look at these two different scenarios, in both scenarios, they spent $90,000 was what their living expenses were. But in scenario number 2, they actually they spent $90,000, but they had to spend another 8K in taxes to get to that living point. And so, when we talk to our clients, would you rather spend $8,000 a year in retirement doing something you enjoy? Would that $8,000 help you stretch the money to last a little longer? And so, not having a tax efficient retirement, while these are kind of rough numbers, it gives you a really good idea of just how much the opportunity is of money that can be saved or spent elsewhere if you plan properly. So getting to this point, getting to the tax-free retirement, how do we get there? And we're going to give some tips and kind of walk you through what we're mostly talking to our clients about. So the first one is 401k contributions. It's free money, right? So you always want to maximize and get whatever your employer match is. You want to maximize and receive that. But anything above the match. So for example, if your employer matches 100% of the first 3% that you contribute, so they're dollar for dollar with you up to 3% of your pay. Contribute to 3% to get the money that your employer will match. But anything above the 3%, you really should, review your plan or talk to a financial planner before you do it, because it may be better to put those dollars above the 3% that are no longer being matched into a different bucket. Maybe we look at funding bucket 3 instead of bucket 2 with that additional money. And really the most critical part of getting to this tax-free plan, as we reflect back on the Prescott case study, is we have to find a way to really aggressively fill bucket number 3. And it's the most difficult bucket to fill because, number one, most people aren't really aware of the need to fund this vehicle. They've been trained to believe that a 401k is the only way, or an IRA is the only way to save for retirement. And so filling this bucket number 3 is kind of a challenge. So there's a couple different ways that you can get there. You can fund a Roth IRA if you're eligible, and I'll come back to that in a minute. If you have an employer-sponsored Roth 401k, which a lot of people have this and don't realize, this is a great vehicle for you to put money away into bucket number 3. You can utilize something called a backdoor Roth IRA, which our firm can help you with, or if you have another CPA or financial planner that can assist you, they can kind of explain the logistics of a backdoor Roth. And then the other option is life insurance. And this is a very complicated vehicle. Going back to Dave Ramsey, a lot of financial planners tell you buy term and invest the rest. But there is kind of a loophole in life insurance investing that allows you to use that as a tax-free bucket. I'm not just referring to leaving money behind for your beneficiaries. There is a loophole where you can use that for income for yourself during your lifespan, your retirement. Very complicated vehicle. I'm not going to go into how that functions today. The best piece of advice that I can give you is, if you want to learn more about this, the book that I referenced back at the start, The Power of Zero, gives a brief introduction. You can reach out to our firm to assist, but be wary of contacting insurance companies that are going to try to sell you annuities or sell you a product that many times is detrimental to your long-term retirement plan. So just be cautious around those. I'm not a big believer in annuities. I'm really not a big believer in buying a lot of financial products. My feeling is there are other ways to invest your money. I'll kind of go into the investing tips at the end, but